Every country on Earth is in debt. The United States owes more than $38 trillion. The European Union around 14 trillion, Japan nearly 9 trillion. Even oil-rich nations, even export powerhouses, all of them owe enormous sums. So here's the question no one likes to sit with. If everyone owes money, who exactly is owed? Because if you follow the numbers long enough, they stop behaving the way we expect them to. The world is drowning in more than $315 trillion of total debt, nearly 3 times the size of the global economy. And yet the system hasn't collapsed. Markets still function, governments still borrow, money still moves, which suggests something uncomfortable. Debt isn't just a problem, it's not a failure, it's the architecture of the modern world. Every war, every crisis, every boom and every bust rests on an invisible scaffolding of promises, IOUs layered on top of other IOUs. And if you trace the chain of creditors far enough, you discover something unsettling. The world doesn't owe money to one country or one institution. It owes it to itself. But that doesn't mean everyone benefits equally. To understand how we reached a point where debt became money and promises became power, we need to go back. Not to Wall Street, not to central banks, but to a war. 3 centuries ago. This is the part most people never learn. Welcome to the Invisible Driver, where we explore the forces that truly move human behavior. Every country is in debt. That alone should break the math. The United States owes over $38 trillion. The European Union, $14 trillion. Japan has nearly $9 trillion. Even surplus nations like Germany, even oil giants like Saudi Arabia, all deep in the red. Global debt now exceeds $315 trillion. That's nearly 3 times the world's GDP. And here's where the equation fractures. Because for every debtor, there must be a creditor. But if everyone owes, who's left to be owed? The numbers don't line up, not in the way we were taught. There's no external banker standing outside the system collecting interest from the world. The system is the bank. The world owes itself, which creates a strange kind of symmetry. Each nation owes. Each nation lends. Each citizen is both payer and receiver, through taxes, pensions, and portfolios. Debt isn't a line on a spreadsheet. It's a web, interlinked, circular, fragile. It works, not because it balances, but because no one looks down. That's the paradox. The financial system doesn't need to add up. It only needs to keep spinning. And to understand how this circular logic became global architecture, we need to go back, not to a central bank, but to a war, where the national debt was born not as an accident, but as a necessity. It didn't start with Wall Street. It started with war. The year was 1694. England was fighting France, and the crown was running out of gold. There was no central bank, no national bond market, only a king with enemies and empty coffers. But war doesn't wait for accounting. So the monarchy turned to the merchants, not for charity, but for credit. In exchange for future interest, secured by future taxes, a group of London financiers agreed to lend, not to a man, but to a government. In that moment, a new contract was born, one that didn't rely on gold, but on trust. To manage it, the Bank of England was created, not as a warehouse for money, but as a machine for debt. This was the real innovation. The state could now spend what it didn't yet possess. And lenders didn't just get their money back. They got something better, a promise, from the crown, backed by force, law, and tax. And that promise could be traded, bought, sold, used as collateral. It became money. That was the birth of the government bond, not as a failure of discipline, but as a tool of empire. Because once a state could issue debt, it could project power beyond its borders. It could fight wars not with gold, but with belief. And that belief in the promise of repayment, was more scalable than any treasury of coins. England didn't just invent debt, it institutionalized it. And the world followed. France mimicked it. The Netherlands refined it. And a rebellious colony across the Atlantic would soon use it to fund its own revolution. But with every bond issued, something else changed. Not just how states financed themselves, but how they defined power. Because soon, the might of a nation would no longer be measured by its gold, but by something far more abstract. Its credit. Empires used to run on metal. Gold, silver, land, hard assets forcibly extracted. Conquest meant territory, and territory meant tribute. The Spanish sailed for bullion. The Ottomans taxed grain. The British controlled trade routes and the ports that secured them. Power was visible, physical, heavy. But something shifted. As debt became institutionalized, so did a new kind of empire, one that didn't rely on conquest but on confidence, not measured in square miles but in basis points, not enforced by sword but by bond yield. This was the quiet revolution. The imperial army was replaced by the capital market, the battlefield by the balance sheet. Nations that could borrow, cheaply, reliably, predictably, began to eclipse those that could only tax. Because borrowing wasn't weakness. It was leverage. A country that could issue debt in its own currency was no longer constrained by coin. It could mobilize capital overnight, finance war, infrastructure expansion, without waiting for gold to arrive by ship. The ability to print promises became more powerful than the ability to hoard treasure. And in this new game, empires didn't have to extract resources from others. They could extract interest from their own. This is the part most history books skip, that behind every rising power in the modern era, there is not just an army or ideology, but a debt market. France learned this lesson, so did the Dutch, and eventually a new republic across the Atlantic would master it. Because the United States didn't just adopt national debt, it turned it into a global instrument. But before that could happen, something had to shift internally. The public had to become the creditor. The headline number is staggering. $38 trillion. That's the current U.S. national debt. It sounds like a warning, a crisis, a countdown. But the real story lies beneath the number. Who holds it? Roughly 1/3 of that debt is held within the government itself. Trust funds, agencies, and internal accounts. That leaves about $25 trillion classified as publicly held debt. But even that phrase is misleading. Because the majority of those bondholders aren't foreign governments or shadowy foreign entities. They're Americans, pension funds, insurance companies, mutual funds, banks, and the Federal Reserve. Collectively, U.S.-based institutions hold around 2/3 of all publicly traded government debt. That means the Treasury issues bonds, American entities buy them, the Fed sometimes buys them back, and American taxpayers fund the interest payments, which cycle back into American retirement accounts. It's not a conspiracy, it's a mirror. The creditor is the system itself. What about China or Japan? Yes, foreign holders exist. Japan holds close to $1 trillion. China, about $800 billion. Combined, all foreign governments and investors hold around $7 to $8 trillion in U.S. debt. Significant, but not dominant. In fact, China owns about 2% of the total debt. So the idea that America is beholden to Beijing isn't just exaggerated, it's backwards. The U.S. dollar remains the global reserve currency, and U.S. treasuries are still considered the safest financial asset in the world. That's why other countries buy them, not out of charity, but out of strategy. Because holding U.S. debt means holding influence and stability. But it also means something deeper. that global finance runs on mutual entanglement. Everyone holds someone else's IOU. And the United States, more than any other nation, sits at the center of that web. But America isn't alone in this, because the same circular logic applies elsewhere. When Japan buys U.S. bonds and the U.S. funds the IMF and the IMF lends to Europe, and Europe buys bonds from developing nations, a new kind of map begins to emerge, one not drawn by borders but by balance sheets. The United States borrows from Japan. Japan holds U.S. treasuries. The U.S. funds the International Monetary Fund. The IMF lends to Europe. Europe supports development projects in Asia and Africa through the World Bank. And many of those developing nations park their foreign exchange reserves back into Western bonds, mostly denominated in dollars. That's not a conspiracy. It's a loop. Every creditor is a debtor. Every debtor is a creditor. And the system feeds itself through layers of institutional trust. Debt isn't just moving in one direction. It circulates across time zones, across continents, across classes. And behind this structure sits a shared assumption that the promises will be kept, or at least renewed. It's a planetary ledger, not balanced but spinning. And here's the metaphor. Imagine a poker table where every player borrows chips from the next. No one owns the stack. They just hold it for now. The game only works as long as no one stands up, because if one player cashes out, everyone else has to reveal what backs their bets. In this global version, there's no final banker, no vault of value, just a rotating set of IOUs, layered, leveraged, and institutionalized. And at the top of that structure are the central players, not governments, but markets. Because when belief wavers, it's not diplomacy that decides what happens next. It's credit spreads, it's liquidity, it's confidence. And those decisions, who pays more to borrow, who gets cut off, who survives the storm, are no longer made by kings or parliaments. They're made by traders. Governments are elected, but interest rates are not. The true power in modern finance doesn't reside in Congress halls or presidential palaces. It lives in the bond market. Every nation has a credit score, not in stars but in spreads. And every time a country borrows, it enters a silent negotiation with the global capital market. If the market believes borrowing is cheap, if doubt creeps in, the cost spikes. This is the leverage of confidence. When investors worry a country might not repay, or might devalue its currency, or might default altogether, they don't argue. They price it in. Yields rise, liquidity tightens, and a feedback loop begins. Higher borrowing costs make repayment harder. Harder repayment fuels more panic, and when that panic peaks, a government can fall, not by revolution but by refinancing. This is the part political theory rarely mentions. Markets decide who survives. Elections reflect popularity. Markets measure solvency. You can win 60% of the vote and still lose access to capital. Because in a debt-based system, legitimacy isn't granted by ballots alone. It's granted by bondholders. And when they lose faith, so does the system. This is not about fairness, it's about function. When Greece saw its yield spike in 2010, it didn't matter who was in power, the math no longer worked. And the IMF stepped in. But it didn't come empty-handed. It came with terms, austerity, cuts, sacrifice. Because when the market withdraws belief, the only lender left is the one who can rewrite the rules. Which brings us to the next level of power, not just those who trade debt, but those who create it. The central banks. Governments are elected, but interest rates are not. The true power in modern finance doesn't reside in Congress halls or presidential palaces. It lives in the bond market. Every nation has a credit score, not in stars but in spreads. And every time a country borrows, it enters a silent negotiation with the global capital market. If the market believes borrowing is cheap, if doubt creeps in, the cost spikes. This is the leverage of confidence, when investors worry a country might not repay, or might devalue its currency, or might default altogether. They don't argue. They price it in. Yields rise, liquidity tightens, and a feedback loop begins. Higher borrowing costs make repayment harder. Harder repayment fuels more panic, and when that panic peaks, a government can fall, not by revolution, but by refinancing. This is the part political theory rarely mentions. Markets decide who survives. Elections reflect popularity. Markets measure solvency. You can win 60% of the vote and still lose access to capital. Because in a debt-based system, legitimacy isn't granted by ballots alone, it's granted by bondholders. And when they lose faith, so does the system. This is not about fairness, it's about function. When Greece saw its yield spike in 2010, it didn't matter who was in power, the math no longer worked. And the IMF stepped in. But it didn't come empty-handed. It came with terms: austerity, cuts, sacrifice. Because when the market withdraws belief, the only lender left is the one who can rewrite the rules. Which brings us to the next level of power, not just those who trade debt, but those who create it, the central bank. For decades, Greece was part of the loop. It borrowed, it rolled over, it paid interest, it participated. But in 2010, the math broke. Investors began to question whether Greece could keep up the payments. Bond yields surged, spreads widened, liquidity dried up, confidence collapsed. And with it, the illusion of control. Greece didn't lose a war. It lost access to refinancing. The debt hadn't changed. But belief in repayment had. And that belief was the only thing holding the system together. The country turned to the only player left, the International Monetary Fund. The IMF stepped in, along with the European Central Bank and European Commission. They offered a bailout, but not for free. In exchange came conditions: austerity, tax hikes, pension cuts, public sector layoffs. The result wasn't just economic, it was social. Unemployment soared. Hospitals ran short on supplies. Suicide rates increased. An entire generation faced lost opportunities. The creditors remained invisible. Bondholders scattered across the globe. But the cost was paid by teachers, nurses, and small business owners. This is what happens when the rollover mechanism fails. Debt stops being abstract. It becomes a headline, a protest, a referendum. And yet, even after the collapse, after the pain, the contraction, the restructuring, the system rebooted. New loans replaced old ones. Terms were renegotiated, the loop restarted. Not because the debt was gone, but because belief was patched back together, just enough to keep the game going. This is the quiet rule of sovereign finance. The debt is never cleared, it's reissued. Which leads us to the next truth. One few politicians will ever say out loud that sovereign debt was never meant to be repaid. When a household takes on debt, there's an expectation: pay back the principal, with interest, eventually. But sovereign debt plays by different rules. Governments don't retire their debt, they refinance it. Old bonds mature, new bonds replace them. The principal is rolled over, again and again. This isn't an emergency tactic, it's policy. In fact, the entire global financial system is built on the assumption that sovereign debt will not be repaid in full. Because repayment isn't the goal, servicing is. The interest becomes the product, the debt becomes the instrument, and the system keeps moving because the belief in continuity remains. Take Japan. Its national debt exceeds 250% of GDP. More than double the US ratio. And yet, Japan continues to borrow at near zero interest rates. Why? Because investors aren't waiting for repayment. They're waiting for rollover, for renewal, for continuity. In this framework, a government bond isn't a liability to be extinguished, it's collateral to be reused. The U.S. Treasury market functions not as a loan, but as infrastructure. Banks use treasuries as security, central banks use them as reserves. Pension funds use them as ballast. If the U.S. decided, somehow, to pay off its entire debt, what would happen? Liquidity would vanish. Collateral chains would snap. The dollar supply would shrink. Markets would freeze. The system would suffocate on its own repayment. Because debt isn't a cancer to be removed, it's the circulatory system of global finance. Reversal. Paying off the debt would not save the system, it would break it. So instead, governments issue new bonds, not recklessly but rhythmically. Debt becomes a ritual, a heartbeat, a signal that the system is still alive. Which brings us to the final paradox. If debt is a promise, and promises are currency, then who benefits from being the one owed? Who receives the interest? Who holds the paper? Who stands at the top of this financial pyramid? Debt is often framed as a transfer between nations. North versus South, East versus West. Rich countries versus poor ones. But geography is a distraction, because the most consistent transfer is not across borders, but across classes. Every interest payment is a directional flow, from taxpayers to bondholders, from wages to portfolios, from labor to capital. This isn't a conspiracy, it's a structure. When governments borrow, they issue bonds. Those bonds are bought mostly by institutions, pension funds, insurance firms, banks, wealth managers. And those institutions earn interest, steady, predictable, compounded over time. But the money used to pay that interest comes from somewhere. It comes from taxes, from public revenues, from productivity. Which means that over time the financial architecture funnels value upward. Not because of malice, but because of mechanics. Because in this system, those who hold debt are rewarded, and those who service debt are necessary. This is why global indebtedness and global inequality often rise together. Not due to corruption, but due to incentives. The more stable the system becomes, the more predictable the flows. And the more predictable the flows, the more concentrated the gains. This is not a morality tale. There is no villain, no hero. Just a feedback loop, structured by design, sustained by trust, amplified by scale, and the question it leaves behind isn't how much debt is too much, but rather, who benefits when the machine keeps running, and what happens if it ever stops?